Welcome to This Explainer. Right, let's jump straight in. We're unpacking something literally game-changing today. We all know Walmart, right? The absolute king of brick-and-mortar retail. But what you might not realize is that they are quietly undergoing a massive transformation. They are turning into a high-margin tech and advertising powerhouse. And, our timing for looking at this couldn't be better because we're just days away from their critical fiscal Q2 2027 earnings report. This is going to be the exact moment that tests the very foundation of this completely new corporate identity.
So here's our roadmap for today. We're going to hit section 1, the million-dollar question, then move to the new profit flywheel, break down the bull case, flip to the bear case, look at the earnings day watch list, and finally ask buy, hold, or wait.
All right, section 1, the million-dollar question.
With the stock trading up near all-time highs, there's this central debate raging on Wall Street right now. Is Walmart actually still a buy at current levels? Has the market just gotten way ahead of itself and priced in a flawless future? Or is this premium completely justified by the company's brand new business model? It's that classic tug-of-war, right? A genuinely great business versus a really expensive stock price. And all this tension, it's about to hit a boiling point on August 20th. When Walmart drops their earnings on Thursday, it's going to serve as the ultimate catalyst for the stock. This is the moment where the narrative finally meets the hard data. Moving on to Section 2, the new profit flywheel.
Okay, so the old Walmart was a brutally simple game of volume. We're talking paper-thin retail margins of just 4 to 5% on things like groceries and general merch. But today is a totally different story. Walmart is aggressively muscling its way into digital advertising through Walmart Connect. And get this, the margins there are running a staggering 70 to 80%. You've got massive brands like Procter & Gamble and PepsiCo paying top dollar just to tap into Walmart shopper data for targeted ads. It is a completely different ballgame.
Which leads us to this really powerful sequential cycle. Think of it like a giant engine. Step 1, the core retail business drives incredible foot and web traffic. Step 2, all that traffic generates incredibly valuable, granular data on what consumers are doing. Step 3, they use that data to enable hyper-targeted advertising. And step 4, that advertising spins off these huge, high-margin profits that Walmart can just pump right back into the core retail business to keep their prices low. It effectively transforms Walmart into a tech-enabled ecosystem with multiple different profit engines firing all at once.
All right, section 3, the bull case explained. So the bulls are leaning on 4 main pillars here. First up is just overwhelmingly strong customer traffic. Last quarter, U.S. comparable sales were up 4.1% thanks to a solid 3% bump in foot traffic. But actually, the most important part of that is who is walking through the doors. Walmart is actively pulling market share from households earning over $100,000 a year. That is huge. Second, their massive investments in e-commerce, they're finally paying off. It grew 28% in the U.S. last quarter and actually reached profitability. Third, they see this ad growth as highly sustainable. And fourth, they still have those classic defensive, recession-proof qualities. Because, let's face it, people always need groceries regardless of what the economy is doing.
But if there's one metric you really need to wrap your head around, it's this: 44%. That is exactly how much Walmart Connect grew year over year in their last reported quarter. 44%. And analysts are projecting they can sustain a 30 to 40% annual growth rate going forward. So when you combine that with their membership programs, these high-margin segments are now making up roughly a third of Walmart's total operating income. That's just, it's a massive fundamental shift, and it's exactly why bulls argue the math on this company has completely changed.
Let's flip the coin. Section 4, the bear case explained.
Okay, you really have to look at this multiple expansion. Historically, Walmart has hovered around an average of 23 times trailing earnings, but today, it is trading at roughly 40 times, 40! And the thing making the bears absolutely sweat right now is that Amazon, the pioneer of e-commerce and retail digital ads, is trading at about 35 times earnings. The fact that Walmart is currently carrying a steeper valuation multiple than Amazon is a massive, blinking red flag for value investors.
So, the bear case zeroes in on 4 key risks. Number 1, that extreme valuation means you are basically paying nearly double the historical rate for every single dollar of earnings. Number 2, expectations are just sky high right now, which leaves management with literally zero room for error. Number 3, the headwinds are building. We are already seeing some weakness in general merchandise, plus rising fuel costs took a painful $175 million bite out of the last quarter. And finally, number 4, consensus profit estimates for this upcoming quarter have actually been dialed back a bit, dropping from 75 cents down to 73 cents.
To put that caution into perspective, Morningstar currently places a fair value estimate of just $70 per share on the stock. $70. With the stock trading much, much higher than that right now, they're essentially waving a giant warning flag that Walmart might be overvalued by roughly 65% at current levels. So the bear argument boils down to this. It's a fantastic company, absolutely, but a dangerously expensive stock.
Which brings us to Section 5, Earnings Day Watch List. Here are the exact baseline expectations Wall Street has set for this quarter. They are looking for 73 cents in earnings per share on $186.3 billion in revenue. With a massive market cap sitting around $917 billion and a share price near $115, the overall analyst consensus is a buy. But, and this is a big but, it's heavily caveated with caution about that valuation. These are the strict benchmarks Walmart simply has to clear.
Now, beyond just the top and bottom line, there are 5 key metrics you need to be listening for on earnings day. First, Walmart Connect absolutely has to maintain that 40+% growth. Second, we're watching for U.S. comparable sales around 3.6%. If that dips under 3, that's a big warning sign that the lower-income consumer is hurting. Third, e-commerce needs to keep its 20+% growth streak alive. Fourth, we have to see how those pesky fuel costs are eating into margins. But honestly, number 5 is the big one, management guidance. Listen very closely to their tone on consumer spending for the back half of the year. That tone is going to move the stock way more than any backward-looking number will.
And finally, Section 6, Buy, Hold, or Wait.
The big overarching takeaway from this entire explainer really just boils down to this one tension. The transformation to a high-margin data and advertising company, it's undeniably real, and they're executing it brilliantly. But at 40 times earnings, the stock is just plain expensive. You are paying a very steep premium today for all of that assumed future growth.
So how do you actually play this? Well, it completely depends on your profile. If you're a long-term investor who really believes in that flywheel story we talked about, your play is probably to just hold, stomach the short-term volatility, and maybe buy on the dips. Now, if you're new money looking to start a position, patience is going to be your best friend here. A post-earnings sell-off from even a slight miss could give you a much better entry point, ideally somewhere closer to that $100 mark. And if you're a trader, well, this is your classic high-risk, high-reward setup. It's perfectly primed for a massive swing in either direction.
So we've laid out the framework, we've dug into the data, and we've weighed both the bull and the bear cases. But at the end of the day, the strategic call is yours. What do you think? Does this whole tech transformation actually justify the highest valuation in the company's history, or is Wall Street just setting itself up for a really painful reality check? Let me know what your strategic move is in the comments down below, and definitely keep your eyes glued to those numbers when they drop on August 20th.